Let's talk about one of the most powerful numbers in all of finance, the debt to equity ratio. Now, forget the dry accounting for a second. This isn't just a number, it's a story. It tells you about a company's real strategy, its appetite for risk, and frankly, its ambition.
Seriously, think about it. A company's debt isn't just some random liability on a balance sheet. No way. If you know how to read it, it's a narrative. It tells you exactly how a company is fueling its growth, just how much risk it's willing to stomach, and how it plans to win. So today, we're going to decode that story. At its heart, running a company's finances is really just a big balancing act. On one side, you have the money that the owners themselves have invested, and on the other, you've got all the money it's borrowed from other people. The debt to equity ratio, well, that's the tool we use to measure that balance with incredible precision. To put it really simply, this ratio asks one critical question. For every single dollar the owners have put into this business, how many dollars has the company gone out and borrowed? It's a straight-up measure of how much a company leans on borrowed money to run its operations. And this is where you see the real trade-off, the core tension of the whole thing. Using debt or leverage can totally supercharge growth in the returns that shareholders see. But it also brings on a ton of risk, right? You have an obligation to pay that money back, with interest, no matter what. So this D/E ratio, it gives us a front row seat to a company's biggest strategic decisions.
All right, so how do we actually figure this thing out? The formula looks super simple on the surface, but trust me, the devil is in the details, and this is where the real analysis begins. The standard formula is pretty straightforward. You take the total debt and you divide it by the shareholders' equity. So if a company has a DE ratio of 1.0, that means for every dollar of equity, it's got a dollar of debt. The creditors and the shareholders have an exactly equal claim on the company's assets. A ratio of 2.0, well, that means $2 of debt for every $1 of equity. Simple enough, right?
Well, not so fast. The single biggest point of confusion, and where analysts can really get tripped up, comes from that one little term in the numerator, total debt. Depending on what you decide to include in there, you can get a totally different picture of the company's risk profile.
So take a look at this. We've got two main approaches. The broad approach just lumps all liabilities together, everything, including stuff like accounts payable, which is just money owed to suppliers. But the strict approach, the one the pros really favor, zooms in on what's called interest-bearing debt. That's the money the company actually went out and borrowed and has to pay interest on, like bank loans and bonds.
And here's why that distinction is absolutely crucial. Accounts payable is just a natural part of doing business. It's operational. A huge bank loan, on the other hand, that's a deliberate financing decision. By focusing only on the debt that costs them interest, analysts can separate the day-to-day operational noise from the company's real capital structure strategy. It gives you a much clearer signal.
Okay, so we know how to calculate it the right way. Now for the fun part. What does a high number or a low number actually mean? This is where we get into the real-world impact of financial leverage.
Make no mistake, debt is a total double-edged sword. On one side, yeah, high debt means high risk. Those interest payments are mandatory. If profits take a nosedive, that company can find itself in really serious trouble, maybe even facing bankruptcy. But on the flip side, the rewards can be huge. Using borrowed money can magnify the return on equity, or ROE, which is what shareholders care about. Plus, since interest payments are tax deductible, debt is often a cheaper way to get capital than selling more stock, which can fuel way faster growth.
As a general rule of thumb, and I mean very general, a lot of investors and lenders start getting a little nervous when a company's debt-to-equity ratio creeps above 2.0. Now, it's not some magic number, but it's often seen as a yellow flag, a signal of some pretty high financial risk. But here's the thing. That 2.0 number is almost completely meaningless without context. A DE ratio in a vacuum tells you next to nothing. To make any sense of it at all, you absolutely positively have to compare it to other companies in the same industry. And just look at this wild difference. A financial services company, like a bank, might have over $7 of debt for every dollar of equity. Meanwhile, a super stable consumer company, maybe one that sells soda, might have only 20 cents. A number that would scream bankruptcy in one industry is just business as usual in another. So, the billion-dollar question is, why are they so different? Well, it all comes down to the business model. Capital-intensive industries like utilities have to borrow heavily. I mean, think about a power company that needs billions to build a new plant. Financial firms literally use other people's money, liabilities like your bank deposits, as the raw material for their business. And companies with really stable, predictable cash flows can safely handle way more debt than a company in a volatile boom and bust industry. Now, we're not done yet. Even when we're comparing companies within the same industry, the standard DE ratio has some major limitations that every serious analyst needs to know how to handle. The first big flaw is that it relies on something called book value. The equity number on the balance sheet is based on historical costs, what things were worth years ago. This can massively understate a company's true value today, especially for modern businesses. It pretty much ignores priceless, intangible assets like brand reputation, patents, or intellectual property. So what do the pros do? Simple. They calculate a market debt-to-equity ratio. Instead of using that old historical book value of equity, they swap it out for the company's market capitalization. That's its current stock price times the number of shares. It gives you a much more relevant, up-to-the-minute view of the company's leverage. The second limitation, and this is probably the biggest one, is that the D/E ratio is just a static snapshot in time. It's pulled from the balance sheet on a single day and tells you absolutely nothing about a company's ability to actually generate the cash it needs to pay its bills. A company with low debt but terrible cash flow could actually be way riskier than a high-debt company that's just a cash-generating machine. This is exactly why analysts never, ever rely on the DE ratio alone. It's just one tool in a much bigger toolkit. They'll also look at a ratio that compares interest-bearing debt to EBITDA, which is a good proxy for cash flow. They'll use the interest coverage ratio to see if profits can easily cover those interest payments. And they'll check the current ratio to make sure the company can handle its bills that are due, like right now. So, after all these nuances, these adjustments, these extra metrics, what's the final word? What's the big takeaway here? I think the best way to think about it is this. The DE ratio is not the final verdict on a company. It's not the end of the analysis, it's the perfect starting point. It is the first, and maybe the most important question that opens the door to a much deeper investigation into a company's strategy, its risks, and its potential. By understanding what goes into it, the context around it, and its limitations, you can move beyond just seeing a number on a page. You start to see the strategic choices, the competitive pressures, and the incredible story of risk and reward that the company is writing for itself.